The Chinese stock market is on the verge of flipping. Over the past 2 years, being an investor in any Chinese equity has been an extremely painful process. Look, investing in China is not for everybody. It's a very risky country if you don't know what you're doing in the investing space and have very little understanding of what's actually happening in the country. But for me, valuations came down way too low in a country that is way too important for the global supply chain, which is why I've been aggressively investing in equities in the Chinese space over the past 18 months. But with all the volatility in the US market, investors are starting to finally realize that China is actually headed into an expansionary phase this year, meaning most equities should start relaxation as revenue and profits start to climb. And that switch in sentiment is exactly what I want to address in this video, along with the latest delivery numbers of some of the biggest Chinese EV stocks. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Yeah, believe it or not, the Hong Kong stock market is off to its best start since 2018. That is a pretty significant move for an equity market many people had completely canceled off their investing list. And if you want to know why that's the case, look no further than the insane rally that the Chinese stock market has had in Hang Seng from October's lows. The market is up almost 30% in a matter of 1.5 months. The market's just hit a 5-month high, and it's become pretty clear that the downtrend has ended, meaning most Chinese companies can now relax and some of the macroeconomic pressures when it comes to equities, margin calls, and liquidations should come down. And for 2023 at least, one of the biggest catalysts that came out from Alibaba is a big driver for this massive move. Particularly, we got the Ant Group win a massive regulatory nod from the government for a consumer loan business, meaning they can actually raise money, unlike what they were forced to not do back in 2020. And as you guys already know, back in 2020 is when the Chinese stock market debacle really started. In November of 2020 is when Alibaba stock, Tencent, and Meituan all peaked. And obviously what happened in China thereafter was a complete write-off. But to be honest, if you were a contrarian investor and actually understood what Chinese regulators were trying to do here, you'd understand that this was not as big of a risk as most markets were pricing in. Simply because of the macroeconomic headwinds that global economies are facing, people sold off Chinese equities like there was no tomorrow because they considered them to be the most riskiest. But as we all know, even in the US, Chinese equities were not going to get delisted until at least 2024, and that regulators actually wanted scrutiny for most Chinese balance sheets, which they found to be not of a big issue because obviously in November of last year is when they got the nod for Alibaba. And obviously the biggest headline in China, COVID-0, also ended up easing significantly over the past 4 months. Many investors predicted that COVID-0 would be the end of the Chinese economy and that the economy was actually on the brink of a collapse. But let's be honest, that's what the media in the West is all supposed to do. They're supposed to pitch Western companies and completely dismiss Eastern companies, with obviously China being one of the biggest stock markets outside of America. So as a result, I'm not surprised many investors completely understood what was actually going on. It didn't take a genius to realize that after the Party Congress in October of 2022, with Xi Jinping taking the throne back, that COVID-0 would most likely be discarded because obviously the Chinese economy took a massive hit in 2022 with a recession and retail sales that turned negative for the first time in 5 years. And not only that, the government was smart enough to realize that their overall exports, which were their biggest growth driver out of the pandemic, were falling sharply over the past 12 months, as obviously macroeconomic headwinds with higher interest rates reduced demand for goods from China. And so if COVID-0 was still in place, that would cause the Chinese economy to truly collapse. Even the real estate debacle of 2021 was not that big of a deal because it affected mostly rural areas where companies and people were lent out money at a very, very high interest rate. But that was not a problem for urban China, which is where most of the growth is actually taking place. And it really was unfortunate to see so many US investors fall for all this foul play that was going on in the media regarding the events in China. Yes, there were uncertainties. Yes, there were risks. Growth was slowing. Profits were going down for most Chinese companies. But that's what happens in every recession. Recessions are natural. They always happen after growth phases, and China's economy was no different. And it's been in a recession since the start of 2021, and the Hang Seng has had its worst bear market in over 30 years. And as an investor, this is exactly the kinds of opportunities you want to capitalize on, which is exactly what I personally did. My main exposure to Chinese equities was through Alibaba, which obviously trades on the New York Stock Exchange, XPEV Motors, which is my main bet on the Chinese EV electrification race, and the CraneShares China ETF, which has been one of the best performing ETFs over the past few months. And as for the question whether or not I'm going to continue to invest throughout 2023, the answer is yes. Again, China is going through an economic expansionary phase. Interest rates are being cut, savings rates are at all-time highs for Chinese consumers, meaning they're all well equipped to be spending on goods and services like crazy. Recessions are always the best time to invest, and the growth out of recessions always tends to be the fastest and the most aggressive. So for me, bar no external factors that could derail the Chinese economy, 2023 is going to be a year that I'm going to continue to invest in. Even from a technical perspective, these ETFs in the Chinese space are actually starting to break out of their downtrend. This is pretty significant because from a technical standpoint, many investors have completely dismissed even buying the dip in Chinese ETFs for short-term trades because of their extremely aggressive downtrends. And out of nowhere, the Nasdaq Golden Dragon China Index has put in its best first 2 trading days of the year since 2001. This is a sign of the massive undervaluedness of Chinese equities and the strength at which investors are now rushing into them as they understand China is going to be one of the only economies cutting rates in 23. And as for the Chinese EV space particularly, XPEV, NIO, and Li have reported some really impressive numbers in 2022, even though the macroeconomic headwinds have been pretty significant. XPEV did report probably the most disappointing report of all three, but on average amongst all three, the company still grew significantly from 2021, and their product launches are still at all-time highs, with the Chinese EV market still at a very good growth rate. On a year-over-year basis, December 2022 was one of the best years for NIO and Li Auto. XPEV, on the other hand, had a more difficult December because the early 2022 half was extremely good for this company. They put in record numbers in May and June, which ended up pulling a lot of their demand forward. And because now they're ramping up production for one of the new SUVs, the G9, their overall sales are going to decline year over year pretty significantly. But the real thing that I want you guys to keep in mind is that look at this overall 2022 change. On average, all three companies grew around 30% in a year that many people were completely writing off the Chinese economy. So now just think about what can happen in 2023 now that the economy is actually coming out of a recession and monetary policy is being loosened. And more importantly, even from a fundamental standpoint, companies in China are doing extremely well from an income statement and balance sheet perspective. Yes, revenue has been hit because of macroeconomic headwinds, but the way that these companies are innovating is allowing their gross margins to stay relatively stable despite a very difficult environment. XPEV Motors, for example, has a gross margin sitting at around 13.53%, which has improved throughout most of 2022 and is about to hit an all-time high. And as you can see, even as a company like XPEV ramped up production in 2022, launched new models, hired more people, the company's operating expenses are still below their ones for the first quarter of 2022. And this, I think, is something investors completely dismiss for most Chinese companies. Yes, growth is slowing, but growth is still growth. For 2024, we can expect companies to perform even better now that the numbers for 22 and 23 are going to be so low, meaning companies' valuations are going to start expanding even more from a price to sales perspective, meaning equities could outperform US equities in China. We obviously have still a lot of uncertainty with the US, and the situation could obviously change, but I'm pretty excited for how Chinese stocks will perform, whether that be Alibaba, XPEV Motors, or any other Chinese EV company. There's a lot of macroeconomic tailwinds, and it's going to be an interesting time as a stock picker because this will be actually giving you the opportunity to understand which businesses will outperform other businesses, which obviously is the job of our stock picking game. And I think Brendan RN, the Chief Investment Officer of the CraneShares Group, does a really good job of explaining exactly that.
You trust investing in China because I said in the previous segment, parts of their market felt rigged. I said that because you cannot short stocks in the domestic market, and I could not buy domestic shares on the Shanghai Exchange as an American living in America. So it's kind of a closed market outside of the Hang Seng.
Yeah, definitely, Brian. You bring up a good point. You got to look at, say, KWEB is offshore China. It's what foreigners define China, Hong Kong and US China ADRs. And so it's more reflective of what do foreign investors think about China. We can contrast that with the Shanghai and the Shenzhen, which is 95% owned by investors in China. And within Crane Shares, we give people access through the ETF KVA. It's 50 mega cap Chinese Shanghai, Shenzhen names. But it's what the Chinese think about China and what foreigners think about China can be two really, really different things. And they're not synchronized. They move very differently. Yeah. And so just to your point, Brian, it's much more difficult to get access to these Chinese A shares, something that we do for investors at Crane Shares via KVA.
And there's, we kind of have two markets, NASDAQ and NYSE. I know there's some others, but that's kind of our thing. They really have three. They've got Shanghai, they got Shenzhen, and then they've got Hong Kong. How do you differentiate the three? Explain it in layman's terms quickly for our audience, why they are different, and they are.
Yeah, Shanghai, large cap, mega cap, value sectors, financials, energy, materials, industrials. Shenzhen, more like NASDAQ, private companies, mid cap, small cap. Hong Kong, large cap names, but Hong Kong really reflective of what do foreigners think about China versus Shanghai, Shenzhen. What do the Chinese think about China?
Brendan really nailed it on the head there. The Chinese and US investor are completely different. The Hang Seng Index is driven mostly by sentiment here in the West, whereas the actual fundamentals of companies and the Shanghai and Shenzhen indices are driven mostly by investors in the country itself. So who would you trust more in an environment where you want to make an investment decision for the future, not for what's happened in the past? I'll leave that question to you guys. But as usual, guys, make sure you always do your own due diligence. This is simply my opinion and things can obviously change. So let me know your thoughts down in the comment section below.